Today's video is going to be about investing. And the way that I think about investing is with two thought processes. One, how much I'm willing to put into something. And I always use the rule of thumb, never spend more than you make. Now, that doesn't really make sense on the surface if you're thinking in terms of, well, what if I go and get a loan to make an investment? Which is typically what you have to do if you want to buy a house. A house is a type of investment, and you have to get a mortgage if you're just young and starting out to be able to buy a house. And that is an investment, and there's some risk involved. But if you think about your mortgage in terms of your monthly payments, so your mortgage payment, in terms of if you can afford to pay it or not, let's say your mortgage is $2,000 a month. Are you making at least 3 times that in your monthly income? So $6,000 a month. If you are, then that mortgage should be really easy for you to pay because it's only 30% of your income, which is actually just about the threshold that they look at when a bank wants to loan you money. The amount of your mortgage payment cannot be much more than 30% of your total monthly income. So they don't let you go more than that anyway when you get a mortgage. There's rules, blah, blah, blah. So speaking of risk and investing, when you're young, and I would consider this anytime before you're 30, that is the best time to take as many risks as you can possibly afford to do, following the basic rules of money. Never spend more than you make. Always pay your tithing. And the third rule, let's see if I can remember it, is you have to spend money to make money. So investing follows 2 of those money rules. You got to spend money to make money, and you never spend more than you make. So let's talk about 2 investment scenarios that have happened for me personally. One of them is with cryptocurrency. I invested $30,000 in, and 10 of it went to buying some Bitcoin mining machines, and 20,000 of it went to invest in a yield farm where I just let the money sit in there and I make 5, 6, 7% a month interest. The $10,000 investment in the Bitcoin miners was a tax write-off. So that was money that I was willing to spend because I knew it would reduce the amount of taxes I'd have to spend. And I'll get into taxes in another video. But let's just say that $10,000 was a tax write-off, and it makes me $400 a month in income, which equals just about 4 to 5% a year in income. Now with the Bitcoin yield farm, that makes me 5 to 6% a month. So I put in 20,000 and I'm making over $1,000 a month right now. So every year I make $12,000 with it, and I only put in 20,000 once. Now, cryptocurrency could explode. It could just go down to 0 and it would be worthless. So that 20,000 was an amount I was willing to risk, knowing that it would potentially be something I just have to write off, as in I'd never see that money again. And to me, that was an acceptable level of risk because I have plenty of money in reserve for emergencies. So if I die, I've got other sources of income coming in, and I've got my life insurance policy. So I feel like I'm in a really good position to still be taking risks like that. But when you're very first starting out, let's say you want to invest in the stock market, which I think is a great place to start investing. It'll teach you that the value of your money will go up and down over the course of a year or several years. And that's what investments are like. And if you can watch your investment go up and down in value, then that is about the right mindset to have when it comes to investing. You have to be okay with whatever amount of money you put into the investment, pretending like it doesn't exist anymore. And so, again, if you're just starting out, let's say you're 18 years old and you just got your first full-time job and you're making $3,000 or $4,000 a month. The majority of your money is going to go to your housing and food and other bills like that. You should be able to afford at least $100 a month to put into start investing somewhere. And I would suggest either the stock market or cryptocurrency, because you don't have to be an accredited investor for either one of those things. And accredited investors get access to more types of investments that have a higher return on investment than just a regular person. But there are lots more types of opportunities for someone with just a little bit amount of money coming out every day. So there's an investment fund called Sweater, and I invested in that, and you don't have to be accredited, and you don't have to put in a minimum huge amount of money. I think their minimum is like 500 or something. So there are options for getting started in investing for as little as $100. And I would suggest thinking about it in terms of you put that money into whatever your investment is and consider it untouchable for several years. And that way it does have room to grow. But if you do need it in an emergency, then a lot of the options you have right now, you should be able to pull that money back out again. So they call that liquidity. If you can get most of your money back out of the investment, then it's considered liquid. With a lot of the cryptocurrency stuff, it's not really liquid. You have to wait for a while to pull it back out, and even then there's penalties. And then so that reminds me, as far as penalties go, there's another type of investment that if you work for a company and you don't own your own business or anything and you still want to invest somewhere, most companies offer a 401k, which is just a nice way to put money into an investment fund that you don't control, that has really small growth every year, but it's very, very low risk as well. So if you have that option, you might as well take it. And there's some other opportunities for business owners to contribute to a 401k that is a tax write-off. But I will talk about those things in a different video.